Bon après-midi tout le monde, bonjour tout le monde. Bienvenue à cette session sur le prix de transfert. La session va se dérouler en anglais, unless Fernando, you want to do it in French or...
I mean, I want to, I just can't do it. So.
And I can't do it in Spanish neither, so let's go with English for this one. And in this beautiful, snowy afternoon, so we had the snow, especially for your colleagues from France and Mexico, so they can see it because we didn't have any all winter long. Of course, we're going to discuss transfer pricing, so I'm going to start and talk a bit about the new proposed regulation in Canada and the OECD project of Pillar 1 Amount B. And then Fernando will explain to us all the tax reform, the transfer pricing reform that occurred in Mexico was effective last year. So yes, here in Canada, we don't have new transfer pricing rules, but there was a consultation paper that was issued in June 2023 for reforming and modernizing the transfer pricing rules, so Section 247 of the Income Tax Act. So everything that I'm going to present today, nothing is enacted, but so keep in mind that it might change, but it's still, I think, relevant to discuss it. So because it provides an orientation where the Canadas want to go with the transfer pricing rules. So this consultation and the proposed changes to Section 247 are really a direct response to the court decision in Cameco. As some of you may know, that in this decision that was in favor of the taxpayer, but it was detrimental to Canada, and it provided a lot. It was the allocation of profit to a Swiss subsidiary was a lot higher than what Canada would have wanted, and this is one of the main reasons why they decided to do this proposed change to Section 247. So, because they felt that the lack of details in Section 247 led to an overemphasis on intercompany agreement, and then this misallocation of profit that was not in line actually with the economic circumstances and in the economic contribution of the parties. So the objective is really to provide greater clarity on the application of the arm's length principle, and also make sure that Canada is aligned with the international consensus. And they also took the opportunity in this discussion paper to consult on administrative matters such as documentation, the penalty provision, the transfer pricing penalty, and also some simplification of the rules. So, if we go with the direct proposed change to Section 247, the first one is the concept of delineation of the transaction, which is basically the starting point for the analysis of an economic analysis of the transaction, because they want to introduce a rule that would require the control transaction to be determined with reference to its economically relevant characteristics, because there was no such precision and no such guidance in the current rules. And of course, this is again to have less emphasis on intercompany agreements. So, and what they're saying is that economically relevant characteristics will be defined in the new law. And this will, of course, include function, risk, and assets, as we all know for transfer pricing, but also concepts such as business strategies, economic circumstances, and intercompany agreement, to the extent that it is in line with the conduct of the parties. So this is the first rule that they want to introduce. They also want to introduce a rule that would require the scrutiny of the control transaction to be directed at its conditions seen in a broader way than actually what we are looking at is terms and condition, and also more intercompany agreement than the economic substance of it. So these are the two proposed rules for the delineation of the transaction, which is a concept we're seeing a lot in the OECD right now. Everybody's talking about this one. On comparability, the proposed change is that instead of when we do transfer pricing analysis, we take the transaction and then we compare it with an arm's length transaction. What they want to do is that instead of looking at what a third party would do or arm's length people would do, they want to look at what the parties to the control transaction would have done had they been dealing at arm's length. So not any arm's length people, but the ones that are actually in the control transaction, because that might have an impact on their conduct. So this is the second big change that would occur to Section 247. They want also to repeal the recharacterization rules that are actually at 247.2b and 247.2d, because actually these recharacterization rules, CRA has never been able to enforce it and have been denied a number of times in court right now. So they're going to be replaced by a non-recognition and replacement rule. And the other important change that they propose to Section 247 is introducing the OECD guidelines in the Income Tax Act. So actually, as you know, it is used as a guidance by Canadian tax authorities, but it's not binding and it's not in Section 247. And in previous court cases, it was really mentioned that, yes, it can be used as a guidance, but it was not binding. So what they want to do is to introduce a rule, a consistency rule, to ensure that the transfer pricing rule that will be in the Canadian Income Tax Act are applied in a way that best achieve consistency with the OECD guideline. The approach that they want to take is more a static approach, meaning that any new version of the transfer price, the OECD transfer pricing guidelines, would have to be included by specific legislative amendment instead of automatically adopting new guidance from the OECD. I don't know in Mexico if the OECD guidelines are...
We have a rule that states that they can be used as reference as long as they're not opposed to the local law.
Okay.
What happens most of the times, as we will see, it's opposed to the local law. So I think this is probably one of the best ideas that I've heard in current tax reforms, because when you see conflicts between two authorities, they always go to the OECD guidelines, always, no matter what the local law says. So just having it as a guidance, as it is right now in Canada and in Mexico, usually brings more problems than solutions. If this is going to be achieved, right, it says achieve consistency with the OECD guidelines. If that is true, then you will be lucky when you go into international solutions, because you will already be aligned with what the probably answer will be. So I think that is a great idea.
Yeah, and the UK, in their most recent the legislation has also introduced this static approach as well. So we're not giving a free pass to the OECD to do anything in the guidelines. It still needs to be adopted, but for now, they agree with it. So these are the proposed change to Section 247. If on the administrative side of it, Canada is looking to adopt the local file, master file approach of the OECD, because currently there was no such requirement. They only adopted the country by country reporting. So, and also on the local file, as you know, in Section 247.4, we have a definition, a clear description of what should be in a transfer pricing documentation, and they want to align that with the OECD guidelines. They also discuss having a simplified documentation requirements for lower value transaction and smaller taxpayer. Because for now, there's no threshold. We don't know who has to do a documentation or not, because there's no threshold directly. So what they're saying is that they could have an annual reporting schedule detailing the nature, volume, method, and use and arm's length condition, which seems a lot to me like a T106, but let's see how they want to do it as well. And actually, there is no mention of a threshold in the consultation paper. And finally, they're on the penalty threshold. They want to raise the threshold from 5 million to 10 million. Do you have some? What's the penalty in Mexico? What's the penalty regime?
Well, the penalty usually applies the same one as all other tax omissions or evasions. So there are no specific TP penalties, right? So you have to go to the general tax rules and see which one applies. There's one thing that I want to know a little bit more about the simplified documentation. If we go back 7 years, the OECD was all about simplifying both documentation and requirements for certain type of taxpayers. Then BEPS came into the scene, and then we went back to over documentation, right, and make it everything harder and longer. How do you see that being combined, complying with all of the BEPS new requirements with the simplified documentation?
I think that for smaller taxpayer, that this probably will help them to lower the burden and the administrative burden of having the transfer pricing documentation. But I think that on large M&As, and there's a lot of them in the room, I think that this will not simplify at all. And that the need to have documentation will be higher and higher. I don't know what you think.
Because in order to determine if, well, for small taxpayers, it makes completely sense. We do have a threshold in Mexico, but for really, really small taxpayers, our taxpayers with less than, it's about $700,000 US in revenue annually, are the ones that do not have to prepare and keep the documentation. So it's really small taxpayers. But the lower value transactions, in order to determine if it's a lower value transactions like we will see in Pillar 1 and Pillar 2, you have to spend a lot of time just to figure out if you fit that description. So you will probably not be required to have a complete documentation, but the time spent just to see if you qualify in order to be a lower value transaction, it'll be much more than the documentation.
So. And if this annual reporting is need to be filed, for example, there's a lot of smaller taxpayers that don't have any transfer pricing documentation, and if they do have to have like an extended T106 or something, I think that in Mexico you have to file a benchmark. So if we go this way, so maybe it won't simplify thing at all. But this is the things that they're looking for right now. And they are also looking for at more simplified and streamlined pricing approach, which is like in line with what the OECD is recommending. So on low value adding intragroup services for now, Canada has not adopted the OECD approach of having a 5% markup and no need to benchmarking it. So they're looking to maybe apply it either as a safe harbor, so you are required. So it may be that you apply the 5% and then you don't have questions on the markup. Or if you want to apply something below or above the 5%, then you would need to justify why you're using other markup, similar maybe to the service cost method in the US. But on the allocation of cost, though, it still need to be justified. So it's most of the time it's not on when you charge management fees, and we see challenges. It's by tax authorities. It's not necessarily on the markup, but on the components, what are in the cost. And I guess that you're going to talk about management fees because I know it's a big topic in Mexico.
Well, so we can talk about that if you want, sure.
I'll leave it to you. Another streamlined approach. I see that, thank you. On financial transaction, and maybe that's one of them that's been the most controversial. They want to limit intragroup loan terms to 5 years. So they don't want taxpayer to enter into like 20 years intragroup loan when the interests are high or low, and depending on what's the purpose of the loan. So they want to limit the terms to 5 years. They want to use that for now, what we're doing when we're determining an arm's length interest rate, we're looking at the credit rating of the borrower. And if it's a public company, then we're using the credit rating of the public company. But depending on the statute, depending of the place of the subsidiary in the structure, then we can notch the credit rating to have a higher rate. So what they're proposing is that we should just use the credit rating of the group because of the implicit support, and also to remove subordination. So an intergroup loan cannot be subordinated to a loan from a third party. So, but these ones, I'm not sure will survive because they did have a lot of questions on it. And the last one that they're looking at and they're saying is to have a kind of a standardized return for distribution activity. So they're basically discussing two approaches. The first one being the safe harbor that we're seeing in Australia or New Zealand, where you have like a price matrix. And if you fit within that matrix, and if, like, for example, if you're not above 6% and below 4%, then you should be okay and don't need to document your distribution activities. And there's the other approach, which will lead me to my other topic, which is the OECD approach of Pillar 1, Amount B. So on Pillar 1, Amount B, which is the buzzword now for TP practitioners since February, like everybody's talking, it get us very excited. I know that probably not people in the room, but like we've been discussing this a lot. So it is an OECD project. And the objective is to simplify and streamline the application of the arm's length principle to baseline marketing and distribution activities. And the overall objective of that is really to help low capacity jurisdiction in their application of the arm's length principle. Like there are some jurisdictions where have less tax auditor or very few comparables that they can use. So applying this Pillar 1 Amount B approach can help them to obtain a better allocation of profit in their jurisdiction. So what's in scope? It's, as it says, baseline distribution activities, or what we mostly refer to as limited risk distributor. So the distributor cannot have any unique or valuable intangible, nor bear significant risk, and has to have retail sales below 20%. It excludes digital goods, so any kind of software as a service, exclude commodities as well, because I think that they still want people to use the cup method, and services, so it excludes these things. And compared to most of the other projects of the OECD for transfer pricing, there is no 750 million euros threshold, so it could apply to any distributor. And it's actually already incorporated in the OECD guideline as an appendix. So how it would work is that if you have a distributor that is within scope, of Pillar 1 Amount B, then you need to calculate the operating asset on sales ratio, the operating expense on sales ratio, and determine in which industry grouping your activities are. Actually, Group 1 is mostly consumables, foods, or like construction material, things that are very rapidly consumed. Industry grouping 3 is more high-level, high-value, like medical equipment, for example, and stuff like that. And grouping 2 is like not everything that's not in 1 and 3, so it's a very, very broad grouping. So, for example, if you have in your group and your structure a limited risk distributor, and that it has a low operating asset on sales ratio and a low operating expense on sales ratio, and it is in group 2, then the return on sales for the distributor would be 1.75 plus minus 0.5%. So this is how we would determine the return on sales for a distributor. As you may, and one of the comments was that this is kind of low. These results are kind of low because what we're seeing in the market right now, when we're doing our comparable search, it's a lot higher than that. But if everybody agrees on this, but then we'll see what happens. So you would determine the return on sales using this matrix, but then test it by looking at what it gives as an operating return on operating expenses. So you take your return on sales and then calculate the operating expense, the return on operating expense. And if you're below 10%, you would increase your return on sales. And if you're above the default cap rate, which varies depending on the factor intensity, then you would lower your return on sales. So this is pretty much what Pillar 1 Amount B looks like. How is it going to be adopted? Because this is something important I did not mention, is that the adoption is optional. So jurisdiction can apply that for years that will start after January 1st, 2025. But it's not. We don't know who's going to use it or not. I think it's fair to assume that probably low-capacity jurisdiction will use matrices like that because it will help them implement the arm's length principle. But and also one other thing that is important is that members of the inclusive framework have agreed not to challenge the results if a low-capacity jurisdiction determine the return of a distributor using this approach, then they would not challenge it because it's all the purpose of that is to help them applying the arm's length principle. So I think that's pretty much what I wanted to say on that. Do you in Mexico have any indication of what they're thinking of Pillar 1 Amount B?
I don't have any direct indication, but I'm pretty sure that it will not be accepted by Mexico. The returns shown in the previous graph, although they may be adjusted, and the adjustment, they will raise those percentages. They are, like you said, lower than what we see in the market. So I'm pretty sure Mexico will not go with it, just as they didn't go with the 5% for the services, and they just want to keep the right to get what they think they need to get in these situations, and it is not mandatory, but it will be in the guidelines in the near future. Yep. So all of those countries that take the OECD guidelines almost as law, they will adopt this.
Yeah.
And countries that don't want to adopt this will not, and we may end up in double taxation because for one country, maybe a 3% will be fine on these terms, but for the other, it should be 4%. So one will be taxed at 3%, and their counterpart will be taxed at 4%. So that'll lead to double taxation, and this is something that I think needs to be discussed at a high level, just to make sure what the implications will be, given that this will be, it's optional, but it would be in the guidelines.
Yeah, and in appendices, but yeah, you're right that, and one thing also to mention is that India did have a lot of reserve, even like there's a full page of reserve from India in the latest the guidance that we received. So because they're asking for more qualitative criteria to be in scope, because for now it's really quantitative. So I think that these are not necessarily the final rules that we're gonna have. So I will give the floor to you to discuss the new transfer pricing rule in Mexico, and then there you go.
Thank you very much. Just to begin talking about this, the largest trade partner for Mexico is the U.S. Canada is third or fifth, depending how you measure it. But if you take this into consideration, then you would think that Mexico would align the TP rules to what the neighbors are doing, just because it's the two countries that we have the most transactions with. But we're actually going away from that. Mexico has decided to take some very difficult decisions in terms of, all right, we want to treat Mexico as a different country with our own rules. These rules do not come from the OECD, as we will see. Actually, they deviate from the OECD. And it's bringing some problems in terms of documentation, but it would bring more problems when we see these transactions challenged by the counter party or the other country which we're having the transaction with. In Mexico, you do need to have a formal transfer pricing report each year. And this report needs to be actualized, and it needs to comply with the local law. This is for every taxpayer, except those small ones that I talked about before, but they're not part of the scope. This documentation needs to be prepared, but does not need to be filed to the tax authority. So you prepare the transfer pricing report and keep it in your drawer. You only take it out of your drawer in case the authorities require you to show it to them. But you are obliged to file one strange thing that it's called Appendix 9 of the DIM. This file or this return asks you very specific questions about your TP report, including the benchmark analysis, how you came up with it, the number of observations that are included in your analysis, all of your transactions that are being analyzed. So it's almost like a summary of your TP report. So although you do not need to file the transfer pricing report, you do need to file this Appendix 9. And in the past, it only applied to foreign transactions. For local transactions, you were not obliged to file this Annex 9, just for foreign. But as of 2022, you do need to include these local transactions. And just to tell you how much more work this became for local taxpayers, it tripled the amount of Appendix 9s that were filed to the tax authorities. So instead of making things more simple, we're complicating things.
And you still have to have the benchmark even though you don't have a TP report, right?
Yeah. Well, you would need to have the TP report. And with that report, you would file this Appendix 9. But the dates that we need to prepare this are complicated. And that is also something that we will see. You mentioned about what's going on with the master file and the local filing in Canada. This goes back to 2015, where the BEPS action plans were being discussed. The final report came out maybe around September of October of 2015. Mexico included this in our law prior. So we were even before this was a final draft. When they were discussing this, Mexico wanted to take the first step, and they included the previous version of the draft. There were no complications. At the end of the day, it was amended to be exactly what the BEPS rule said, but we included them before this was in fact. So there are three specific rules regarding Action 10 of the BEPS plans. The first one is the master file. Master file includes the information of the whole network, right? It's not only for local purposes, but actually it's multinational, and only large taxpayers are required to prepare and file this in Mexico. The country-by-country report, it's aligned with the rest of the world, so only large multinationals, and it only needs to be filled and filed by the ultimate holding. But local file, Mexico, in the beginning, they only wanted to include large taxpayers. A local file, how it's described in the law, it's very similar to a TP report, just larger, bigger, and with much more information. Mm-hmm. But it's let's say, a strengthened TP report. And as of before 2022, only large taxpayers used to be required to file this. They included one section in the article that now, if you're a related party of a large taxpayer, you're also required to prepare fill and file the local file. This, I mentioned that for the Appendix 9, the reform tripled the amount of appendixes. In this time, it's the local files that were filed last year were 10 times more than in the past year. So again, instead of making things simpler, we're going the other way around.
And there's this distinction in Mexico from the TP report and the local file, and it's not the same thing. The local file, you need to file it, is it?
Yeah, the local file, you need to file it, and you need to file it before May 15th.
Yeah.
For all of us that are involved in transfer pricing, we know that at that day, there is no current information in databases and in many other places that we use to come up with information. So this needs to be prepared by May 15th, no matter what the group is doing. So the local file needs to be filed before May 15th. For the master file and the country by country, we do take into consideration what the multinational group is doing. So depending on the month of the month that they end their fiscal year, we usually take that plus 3 months, and that's when we need to file it.
Can it be filed in English, the master file?
Yeah.
Or? Okay.
Yeah. It's one of the probably or the only document that states specifically that can be filed in a different language, such as English. Now, this is where we're just going away from the OECD and from what Canada and the US are doing. And I mention Canada and the US because it's who we should be taking a closer look at and trying to be aligned with them. Not following what they're doing, just trying to be aligned with them. The common practice, it's, all right, in order to prepare your benchmark analysis, you will use 3 years of the comparable companies. That is a common practice. The OECD guidelines do not tell you to do it that way, but they don't tell you to do it otherwise. So it's a common practice. As of 2022 in Mexico, you cannot do that anymore. You're forced to compare the year under analysis versus the same year for the comparable companies. So in this case, we're preparing the transfer pricing reports for the 2023. We need to use information from 2023 for the comparable companies. But not only the same fiscal year, we need to use information from entities that at the end of the day have the same fiscal year as Mexico. So we should be looking for entities with January to December fiscal year and only using that. What's the problem with that? You cannot do that report before May 15th because the information is not out yet. So tax authorities are making us do things that are impossible to do. It's not that we don't want to, it's that we can't. And that's being an issue right now because we have already prepared the 2022 reports the best way we could do them. For the 2023 reports, we have approached the tax authorities and just let them know that what you're asking, it's impossible. It's not viable. You cannot come up with that information at that time. In order to comply with that, we then need to be not as strict in terms of comparability. So we should not take into consideration functions, assets, and risks of the comparable companies in order to just get the companies that actually have that information available. And that does not make sense at all. Right now, there is a memo written by the Accounting Bar Institute in Mexico that tells you, all right, just try to do your best to comply with this. If you can't, all right, do your best. But it's a memo from an organization that has nothing to do with the tax authorities. But this problem is for everyone. We're all facing this situation. Obviously, this is the second year that we will be facing this. So there are no international precedents to tell you how this is being managed. There have not been any audits in terms of transfer pricing so far So I cannot tell you what the tax authorities are doing when they are auditing the report, and we will not know that until 2 or 3 years. Why? Because usually the audits come 4 or 5 years after the year has closed. But this is a huge issue. All the 100% of the transfer pricing reports prepared for 2022 and the ones that will be prepared for 2023 are not fully compliant with the Mexican income tax law just because of that. If you do an update on August or September where the information is available, then maybe you have certainty. But remember, we need to file this before May 15th. So that wouldn't even make sense. The next one is, in the past, all right, you search for your comparable transactions or companies, and with that information, you have several alternatives how to prove the arm's length principle. As of today, the only way that you can use that information is through an interquartile range. You cannot do any other method. You cannot use that information any other way. And for most cases, that's okay. But what happens if you only have 2 comparable transactions? Then when you apply this methodology, then you end up with 5 different observations from 2. Doesn't make sense. What happens if you only get 1? Then your interquartile range will be the exact same amount for each one of the quartals.
And I guess that because you have to file for May 15, your range of comparable, the number of comparable available should be very reduced because of that. So how can you have a interquartile range with 2 observations?
And for many type of transactions, you don't come up with several observations, maybe just 1. And if you want to follow what the law states, you will need to apply the interquartile range methodology to that observation, which, again, doesn't make sense.
Is it like 25th to 75 percentile or 35, 68, 65? Like
25 to 75.
Because in India, they're stating it's 35 to 65.
Don't tell that to the Mexican tax authorities because they will try to apply that also. And for the maquiladora industry, I will not go very deep here because my colleague Mario will speak of this later on. But the maquiladora industry, it's a very particular industry in Mexico. Much of the interaction between Mexico, the US, and Canada, it's because Mexico has manufacturing facilities to provide services to these to these countries. Several years ago, Mexico wanted to bring investments from other countries, so they applied a unique regime for the maquiladora industry, and they had several benefits. From income tax, VAT, and other benefits. This was in the late 1990s. So they did bring a lot of money. They invested in Mexico, and many of the cities that are on the border between Mexico and the U.S. have tons of facilities that are maquiladora. In the past, you were able to prove that you're complying with the arm's length principle through 3 separate ways. The first one, it was through an APA, which is the only methodology that gives you certainty that the local tax authorities will agree with what you're doing. The second one was through an adjusted transfer pricing report. And the third one was through a safe harbor. This safe harbor comes from the late 1990s. This is very important because as of today, the only way to comply for the maquiladora industry with transfer pricing provisions, it's through the safe harbor. You cannot apply an APA anymore.
There's no APA.
There's no transfer pricing report, so you have to go to the safe harbor. And the safe harbor margins, when they were calculated, they tried to comply with the arm's length principle, but that was in the late 1990s. Do you think the world has changed in the last 20 years?
A bit.
I believe so. So right now, those margins do not apply to reality, not even close. They do not have, they have nothing to do with the real world. So it's very expensive. You're talking about a 6.5 or 6.9 margin for an entity that is just providing contract manufacturing services. They don't own the inventory. They don't own the machinery. So they are just providing a service. So those margins are very high. But as of today, it is the only way to comply with transfer pricing rules. Again, I don't want to get more into Maquila. Mario will tell us a little bit more. And just to finish, there are 3 separate dates. Well, 2 that divide into 3. 3 ways that you're obliged, or when you're obliged to have the transfer pricing documentation. The first one, it's for regular taxpayers. They are not large taxpayers, but they are not the smallest one. They need to prepare a return that it's called DACIF, and this needs to be prepared by March 30th. So in this first type of taxpayers, again, that are just in the middle, the transfer pricing report needs to be prepared by May 30th. Not even May 15th, right? So right now we're in March. Will we have enough information? No. Will the taxpayer have all of the information to prepare the report? The answer is no. But it doesn't matter.
Yeah, they don't care.
You need to come up with your transfer pricing report. Taxpayers that need to prepare a statutory tax report that they are obliged to. What is a statutory tax report? It's a tax report that you need to file to the tax authorities, and it needs to be prepared by a certified accountant. This is not prepared by the entity. They usually hire a third party, and this third party is the one that files this statutory tax report. This is only for the largest taxpayers in Mexico, and this needs to be done by May 15th. In this statutory tax report, you need to include specific questions about the transfer pricing report. So in order to file it completely, you need the report. And for the rest of the taxpayers, they all need to fill and file the Appendix 9 of the DIM, and the due date is May 15th. So even though there is, well, excluding the local file, there is no obligation to have the transfer pricing report by such date. All of these documents ask questions about the transfer pricing report, and if you don't have the report, you cannot file this. So at the end of the day, you need to have that ready by then. These are the novelties, Marie, and just going back to what you mentioned about the management fees. Mexico, it's a country that it's used to pay management fees to the corporate. These management fees may be for a whole range of services received, from just administrative, corporate, treasury. There are many concepts that may be included in these management fees. We have been paying them always, so it's nothing new. But what is new? It was the perfect mechanism for certain entities to, try to bring back some of their investments without any other implication. So what they did, for instance, in times of crisis, economic crisis, they would raise the management fee, so they would charge more to Mexico, right? Include that in the local numbers, and do better in that jurisdiction. So Mexico is very strict about these management fees. You need to first prove that they were received. Proof.
Like timesheets and like
timesheets, time spent by the people that are actually involved in this. You need to have all of the documentation in place, formal documentation such as the agreement and the invoice. The invoice needs to be on the same date of the when the service was received. So, for instance, if you received the service during 2023, but the invoice is dated 2024, I'm sorry, that is non-deductible for Mexican purposes. And the other issue that right now it's relevant, it's, all right, you're being questioned about this 5 years after it happened. So how can you prove that that service was received 5 years ago? You need to prove also that there was a benefit for those services received. So we have some clients in common that this has been a huge challenge because, all right, this is done by all of the multinational groups, but they want to do it properly. And when they ask us, all right, what do I need to do in order to show and prove that this service was received and that there was a benefit? We're talking about a service. It's not material. So
and sometimes it's corporate costs that are just reallocated within the subsidiaries, but in Mexico they could deny it because there's no. If we cannot demonstrate that, what I understand, there's a specific benefit to Mexico, then it would be denied. And I also heard, and we'll finish, I guess, with that, and that if you don't have your intercompany agreement signed before charging or starting a transaction, that they could deny the payment as well.
Not only that. You have to have certainty or a proof that agreement was actually signed when you said it was. So it is not enough that you have that paper signed. Right now, they are asking you to prove that it was signed on the date that says. So
no simplification in Mexico.
No, not at all. Not at all. But we're never bored. That's a good thing.
That's true.